Hello, mortgage fans. So after a very hot weekend, I suspect a few of us a little bit hungover, a little bit sunburned, or probably both. Because that's how us Brits deal with the heat, isn't it? We sit in 30-degree heat, drink our own body weight in alcohol, and have partially cooked barbecue and wonder why we feel so rubbish the next day. Wonder why that is. But what a difference a week makes. Last week we had the disappointment of the Euros final and all the disappointment of some of the idiots around that as well. But this week you have Lewis Hamilton literally flying the flag and winning an absolutely stunning Grand Prix. And also we've got the Olympics coming up on Friday as well. I'm personally a huge boxing fan, and we're sending possibly the best boxing team we've ever sent. So I'm expecting a lot of gold to come out of Tokyo, and I hope we can focus on the things we should be focusing on, which is an absolutely golden era for UK sport as a whole. And really some great role models. I personally prefer to look at the heroes in life. That's just a personal thing. If you look at the good people and emulate them, you tend to be in a good place. I tend to not focus on idiots because they just suck the oxygen out of where you should be. But more importantly then, and we're here for some mortgage chat, so let's sort of dive straight into that. Another sort of interesting dynamic, and this one I've talked about a lot over the recent weeks, is inflation. Last week inflation went up again to 2.5%, up from 2.1% the month prior, and there's no signs of that settling down anytime soon. So the Bank of England have a huge headache now about what they're going to do. Interestingly, it was a member of the MPC committee. So the MPC is the Monetary Policy Committee, which is the rate setting section of the Bank of England. One of their members, Dave Ramsden, came out and said we're probably going to have to remove fiscal stimulus sooner than we thought. So what that means in English is probably going to have to stop quantitative easing or going to have to raise interest rates. Something's probably going to happen in that sort of area. Now, I'm a real geek, and I could get into this in huge detail, but I'm just going to sort of keep it fairly high level for now. Those comments did have an impact on financial markets. The Bank of England meet every other month. Sorry, they meet every month and miss the third month. It's a bit of a strange setup. That's why I can't explain how it happens. But they meet 2 months and then have a month off. So the next meeting is on the 5th of August, though. What is happening in money markets is they're pretty much all up. So they're sort of banking on the Bank of England raising rates in the short term. One of the big drivers or certainly one of the big ways you can see if interest rates are going to move or not is something called LIBOR, which is the interbank offer rate. That's the rate at which banks borrow money from each other. There's lots of benchmarks from daily to 6 months, etc. So the benchmark we tend to look at is 3-month sterling LIBOR. That's the one we sort of tend to look at. Now, sort of going back to sort of the more classic sort of dynamic, what happens is if LIBOR goes above the Bank of England base rate, we expect to see a rate movement in that direction. And then how far above it is the base rate is how likely that is to happen. So I'm not going to get bogged down too much detail. That's the basic principle. At the moment, LIBOR is actually below the Bank of England base rate. Reason being, up until fairly recently, we were talking about negative interest rates. So that's going to take a little bit of time to play out. What's interesting is swap rates. So these typically fund 2 or 5 year mortgages because that's when banks buy money in wholesale for 2 to 5 year periods. Now they're both markedly up last week. I believe it was 2-year money is up 13% and 5-year money is up 11%. Now in any financial market, if you get a 10% swing in a week, and that was actually just a few days after Dave Ramsden's comments, it's showing you that money markets are pricing in higher cost of funds over the next 2 to 5 years. But because LIBOR hasn't moved, that's not likely to happen in the next 3 months. That's sort of how I look at things, and that's how we sort of gauge where we're going and ultimately the advice we give our clients. So there's some of the key dynamics to look at, something we're really going to keep an eye on over the coming weeks. If you want a really detailed breakdown of inflation and interest rates and that classic sort of relationship, there is a blog that I put on our website. I'll link it into the comments as well. Please do have a read of that because that will talk about a lot more detail. So this is just sort of general update today if you look at that more specifically. Because in normal times, at the moment we've got inflation going up, GDP going up. You would expect interest rates to go up, but we're far from normal times. So that's something really big to keep an eye on. Next point that I sort of picked out from last week was rents on the rise. This is some figures from the Office of National Statistics, where they look at the regions of the UK and how it's performing or not in some cases. So there was a very modest rise nationally of 1.2% last year, so rents are increasing again after a very stagnant period. Again, it's hugely sort of regionally varied. So the highest growing areas are the East and West Midlands, both moving up 2.4% in the last 12 months. Interestingly, London is down 0.1%. Now, if you go back to what I said, there inflation going up at 2.5%, but then rent actually going down, that's actually really losing ground in sort of real terms. Again, not economics track, but if you look at things in real terms, that sort of rent's going quite backwards. Now, that's part of a trend we've seen really since lockdown, where people are moving out of London into cheaper areas. That's starting to turn into a long-term trend. So if you're renting, you're looking to keep your costs down. If you're only going to be in the office once or twice a week, or sometimes never, because some companies have moved completely home working. Some people do want everyone back in the office, but there's probably a good slug of firms that are sort of this new sort of hybrid working we're talking about. So we could sort of see that sort of bottoming out. That could be sort of the low point, and because London starts to recover again, particularly as things open up. Later this year and next. I mean, technically it's Freedom Day today, although ironically I'm at home with my daughter because she's isolating because their nursery's shut. So a bit of an irony of Freedom Day for me. But you know, these trends will sort of change, and again, it's something really to look at, because the buy-to-let sector has just been absolutely, I can't think of a polite word to put on it. It's been a target, shall we say, for the government with the tax treatment, all the stuff through COVID and rents. It's just really, really difficult if you're a landlord right now. And I don't think anyone cries tears for landlords, but equally, you know, if you're renting, you do need, you know, somewhere to live. It's very simple. And if the if the supply goes down, costs go up. And that was the interesting point I picked out of this, is that RICS, the Royal Institute of Chartered Surveyors, so this is now the first time where supply is outstripping demand. Now again, economics 101, when that happens, prices tend to go up. So that's why I picked that particularly. It's interesting what the ONS said, interesting what RICS said. So it looks like rents are going to start to increase from this point on. So that sort of shuffling around we had through COVID seems to have bottomed out, and we should see some growth in that sector again now. Now, how that plays out with interest rates, now I've sort of talked about sort of money markets quite a lot at the outset, but just to give you the high level numbers. So 3-month sterling LIBOR, as I discussed, that's currently at 0.078%. 2-year money is gone to 0.431, and 5-year money is at 0.679%. So as I said, quite significant moves up in those markets just on the week. So let's see what happens next week. So how that translates into mortgage rates then. So the best variable rate you can get on the market right now is 0.99%. The best 2-year rate is 0.94%, and the best 5-year is at 1.19%. Now that's typically for people with a very large deposit and a very straightforward situation. The exact rate you'd be offered will be dependent upon your deposit and your situation, because if you think the market leading 95% rate, I believe is at 3.34 currently. So it's also a big range, and you'll sit somewhere within that depending on your situation. Last little footnote for me is we put a new video out last week. If you're self-employed like me and looking to get a mortgage, I did a fairly detailed video, I think it's 5-6 minutes long, and it really focuses around the impact of COVID and the sorts of things you're going to see going forward. So if you are self-employed, and just to be clear on the definition of that, it's typically if you own 25% or more of the shares of the business you work in. So some people get very confused about your tax position and your mortgage position. They're two different things. So you could own 50% of the business, or even 100% of the business like me, but it'd be your sole source of income, so your PAYE, you're on the payroll, but you're still treated as self-employed, as yours seem to have a huge influence on the performance of that business. So if you want more on that video, please go to our YouTube channel, check them out, and next week we'll catch up and see what goes on then. Have a good week.